Brian, is this a market event at all?
No, I don't think so. I think the market still is very poised here at the last week of the quarter. In terms of repositioning, we had a little bit of window dressing last week. I think the market's still very, very concerned with respect to what's going to happen in earnings in the first quarter. I think, again, investors have learned that politics are events on a short-term basis, but fundamentals drive stocks. And, people are a little bit near-term worried about what the bond market is saying. We think those worries are overblown, by the way.
Why?
Why? Well, first off, from a fundamental perspective, David, earnings have gone down too much. And we have a model that we've used as Strategist now for over 20 years that sees FY2 earnings that went down to historic lows in January and February, meaning all the lemmings, meaning analysts dropped their numbers at the same time. And now we've actually seen numbers start to tick up a little bit on a relative and absolute basis compared to the last couple of months. So we actually think that the earnings recession is not going to happen, and most investors have become way too negative. And the reason why they become negative, by the way, is because they missed the move. They missed the move in January especially, and now they're piling on to the negativity. I've never seen, in my almost 30 years in the business, never seen so many people be negative with stock market numbers being within an eyelash of new highs. Never seen it. So that tells me that people are not fully invested, tells me that the outflows that we saw in 2017 and 2018 are causing people to underperform in their asset allocation. And we're going to have some bumpy roads, there's no doubt about it, in terms of 2019 trading. But I do believe the political news that we had over the weekend really has nothing to do with what's happening.
But that doesn't really answer the question as to why the warning signs that are flashing red in the bond market are not worrisome for investors.
Well, here's why they're not worrisome, okay? The United States of America is the strongest GDP in the world. Okay, we can go it alone without the rest of the world. We have built strategies in our investment portfolios that have so relied on international investing. We already know that China's in trouble. We already know that Europe's next Japan. We already know that emerging markets have had issues. We think the investment in American equities has been way underinvested, and we think money's coming back to the home of stability, which will be U.S. stocks.
Brian, curious to get your take on that. You agree with, Barry, you agree with what Brian just said?
No, I disagree. There's no way the U.S. will remain an oasis of prosperity in a very troubled world. The Fed made a mistake with the December rate hike. We've been saying they would actually cut rates by this summer. The middle quarter's earnings are not going to have a lift-off for this year, and we calculated a 50 basis point real rate using core PCE. The S&P is worth about 17 times this year's number. The problem is I use an S&P data feed for earnings, and I've got $161 this year. The street's at 166 and has been coming down since last summer. So at my numbers, the market's fairly valued around $27.50, and that's why it's in stasis right now.
Oh, we're going to have a real debate here. I think you just disagreed with everything you said, Brian, including the earnings expectations versus where they are in the market.
Yeah, I think, with all due respect, PE ratios are the world's worst predictor of markets. Earnings are, and with the path of what's happening fundamentally. We've learned in the last 20 to 25 years that a dividend discount model is a better model on the market and more predictive. We also know that macro regression models have actually started to tick up because economic data in the United States is a little bit better. With the U.S. using or making 70% of everything that we do here in our country, I think we can go it alone. It's not pie in the sky, lollipops and rainbows. We're going to have issues. But I do think that once and if we get this positive China accord, I don't believe that the China accord is priced into stocks because we're still dealing with excessively reactive portfolio managers that won't do anything until they absolutely positively see it.
I don't believe it's priced in.
Absolutely not.
Really?
No, I have the good fortune of speaking to portfolio managers around the world, and we market all the time, whether or not it's hedge funds or portfolio managers, and they remain excessively negative. They don't believe anything's going to happen, and I believe just because we're so afraid to be right, we don't want to be wrong, we are not positioned accordingly. We're so positioned short term, we're not thinking about where the puck is going. We're thinking about where the puck is right now, to use a hockey term.
And Barry, so, Brian says we're insulated to a certain extent from the concerns in the rest of the world. You clearly disagree. Do you think, though, that there is upside in this market if we do get a trade accord with China?
On the China trade, the political environment, it argues for that to be put on the back burner, at least until after the 2020 elections. That's not really the biggest issue right now. The biggest issue is the Fed and what they do with rates. The market's like a hungry ogre. The pause was not enough. And then the taper of the quantitative tightening was not enough. They had to actually signal a quick taper. Now the market's going to demand a rate hike, and it's doing that partly through the yield curve inversion. You see it in the difference between the 10 to 2 and the 10 to 1 year. They're expecting rate cuts, pardon me. As for the comment about price to earnings ratio, PE times earnings is the price, so I think it does matter. And then when I look at the inflows to which Brian referred, that actually strengthens the dollar, which weakens S&P earnings. So I'm not as optimistic. I think that we're in a holding pattern here, and that's because there are a lot of cross currents that don't argue for a rapid takeoff in the market beyond what we've already seen since December.
I mean, we could argue about PEs, but also on the China trade deal and just what's priced in. There's also this question about whether tariffs will go away, even if they do reach a deal, and whether that could still be an overhang for global growth and earnings.
I think it's really difficult to judge exactly with respect to what's going to happen in terms of not only the steel tariffs, but the aluminum tariffs. It's clearly had an issue with respect to that industry. But remember, too, that if you take a look at steel and aluminum as part of the market, very small, less than 1.5 percentage points of the S&P 500. I think what people are missing here is that the Fed clearly, per Mr. Bannister's comment, really drove a lot of the volatility in the fourth quarter. So that's why we've been saying, we put out a piece last week saying that this generation's 1995 is this year. Fed misstepped in 1994. We had a huge move at the end of the 94 into 1995. I'm not saying the Fed's going to cut. I think that remains to be seen. However, the Fed clearly misstepped, and it's already happened. And we think this generation's 1995 is happening right now.
So Barry doesn't think we're going higher than in this 2,700 region. What's your end target?
3,000.
Bullish. Barry, final word to you.
Yeah, the only thing I would say about the Mueller investigation is the market is a fabulous discounting mechanism. It never really put much stock in that whole story. 10 years ago, the Republicans pushed a canard about weapons of mass destruction in Iraq, and it cost them at the ballot box. Now, if the Democrats persist on the Russian collusion hoax, it'll cost them. I think you'll see a shift to more, hopefully more bipartisanship, and we've really got to keep an eye on this raising of the budget. The debt ceiling for the budget. If we don't get that done on a smooth basis, we'll be back in the kind of soup we were in 2011, 2012, when Washington kept us on edge about treasuries.